Overnight repo rates just spiked above 6%. That is a level we haven't seen in years, and it is not normal. Something is tightening in the U.S. financial system, quietly and without headlines, but it has the potential to ripple across markets if ignored. And when funding costs for the safest collateral in the world start jumping, it's a clear signal. Liquidity is under pressure. Treasuries, hedge funds, dealers all rely on this plumbing to function smoothly. And right now, the plumbing is straining. Most people miss this because the S&P 500 is still calm and volatility looks muted. But underneath, risk is quietly rising. This is the key part. The repo market often signals stress before equity or credit markets react. That means by the time stock prices move, the warning has already been missed. If you're trading treasuries, equities, or leveraged positions, this could affect your portfolio before most realize it. In the next 2 minutes, I'll show you why this matters for US traders. If this spread surprised you, hit like so more traders can see this. Here's where it gets important. Elevated repo rates do not signal panic. They signal fragility. Movements feel sharper, pullbacks recover slower, and risk-taking behavior quietly changes. And all of this happens without headlines, dramatic stories, or media attention. The numbers speak for themselves. Overnight funding is not supposed to be this high under normal conditions, and this divergence is a warning about the state of liquidity in the system. This is subtle, but it matters. To understand why this is critical, you need to understand how the repo market functions and why it is so central to market stability. Banks, hedge funds, and other large institutions rely on repo to fund positions in treasuries and other high-quality collateral. This is how market makers maintain inventories and how leveraged portfolios stay balanced day to day. Under normal conditions, repo rates closely track the Federal Reserve's administered range. Small deviations are expected, persistent premiums are not. Most traders overlook this subtlety, but liquidity is not only about how much cash exists in aggregate, it is about where that cash sits and who can access it when needed. Today, reserves may appear abundant, but distribution is uneven across key market participants. Treasury issuance remains elevated, and dealers are absorbing more supply than usual. Quantitative tightening is slowly draining liquidity from the system. These structural pressures create pockets of stress that manifest first in repo markets, before appearing in other areas. This is the key part. When repo spreads fail to normalize through arbitrage, it signals that something is blocking smooth market functioning. It could be regulatory constraints, capital requirements, or risk aversion among participants. The impact may seem subtle initially, but it has serious downstream effects. Historical examples illustrate why monitoring repo rates is so important. In September 2019, repo rates spiked unexpectedly, pushing overnight funding to levels that triggered market concern. Equity markets barely reacted, and many commentators dismissed it as a technical blip. However, the Federal Reserve quickly stepped in with liquidity injections to restore normal functioning. Similarly, in March 2020, repo stress coincided with Treasury sell-offs and broader market disruptions, forcing massive intervention. The pattern is consistent. Funding stress appears first, price adjustments follow. Understanding this sequence is essential for anyone active in U.S. markets. Most traders focus exclusively on headline volatility, but by then, the early warning has already passed. Today's elevated repo rates are sending a similar cautionary signal. Leverage is more expensive. Dealers reduce inventory. Market depth shrinks. Treasuries experience initial impacts. Credit markets follow. And equities ultimately feel the strain. Bid-ask spreads widen. Price gaps increase and volatility becomes asymmetric. Quick check. Does this worry you? Type yes or no. The deeper implication is that even if headline volatility remains muted, structural fragility is growing beneath the surface. Elevated funding costs constrain liquidity, and risk-taking behavior begins to adjust quietly. Hedge funds, dealers, and other participants reduce leverage, shorten duration, and widen spreads. Small shocks are amplified, and the system's ability to absorb larger ones diminishes. This is the key part. Repo spreads do not predict crashes, but they predict vulnerability. Mild scenarios result in spreads normalizing, liquidity returning, and markets moving on without significant disruption. Moderate scenarios involve persistent stress, thin liquidity, and amplified market reactions to data or policy surprises. Severe scenarios occur when a sudden catalyst, such as a weak treasury auction, a policy misstep, or a macroeconomic shock, spikes funding costs, forcing rapid repricing in treasuries and accelerating sell-offs in equities and credit. Understanding these patterns allows traders and investors to prepare rather than react. Most market participants overlook the subtlety. When funding costs rise, upside potential is capped before downside accelerates. This matters for both short-term traders and long-term investors. For traders, elevated funding costs reduce the profitability of leveraged trades and increase the cost of maintaining positions overnight. For longer-term investors, thin liquidity can distort price signals, making traditional risk models less reliable. This is the key part. By monitoring repo rates, treasury spreads, and bid-ask behavior, you gain an early understanding of market stress before it appears in equities or credit. It's not a perfect predictor, but it's one of the most reliable warning signals available. Quick reminder, if this spread surprised you, hit like so more traders can see this. Even calm markets can hide underlying stress. Elevated repo rates indicate that participants are acting defensively, whether consciously or unconsciously. Leverage is reduced, balance sheets are adjusted, and inventories are selectively maintained. The effect is subtle but cumulative. Risk is quietly shifting. Markets become less forgiving. Price moves accelerate more quickly than expected. Slippage increases. Rallies lose follow-through. These changes may not appear immediately in headline indices, but they matter for anyone executing trades or holding positions. Let's break down what this means for U.S. markets specifically. When funding tightens, Treasury yields can rise independently of inflation expectations. Dealers are forced to balance inventory, and the cost of holding duration increases. Credit spreads can widen as risk appetite diminishes. Equities may appear stable for the moment, but thin liquidity makes downside moves more severe and recoveries slower. Most people miss this because they focus on price levels rather than the underlying funding environment. This is the key part. Liquidity, leverage, and funding costs drive market behavior in ways that headline data often fails to capture. Elevated repo rates are an early warning signal of stress that can propagate across asset classes. Now, let's discuss scenarios and risk management. In a mild case, repo spreads normalize quietly, liquidity returns, and markets continue to operate without significant disruption. In a moderate case, stress persists, liquidity remains thin, and reactions to news or policy changes become exaggerated. In severe cases, a trigger, weak auction, policy shift, or macro shock causes funding costs to spike, treasuries to gap, and equities and credit to repricing rapidly. The market does not fail immediately, but stress accumulates until it can no longer be absorbed. Most people miss this subtle escalation. By the time it becomes visible in equities or credit, the window to act early has passed. Here's where it gets important. Monitoring repo rates and funding spreads is not speculation. It is risk management. Traders should track overnight rates relative to Fed facilities, Treasury liquidity, and bid-ask spreads. Investors should consider how elevated funding costs affect portfolio construction, risk appetite, and duration exposure. Thin liquidity may limit upside even in favorable environments, while downside moves can be amplified. This is the key part. Ignoring these signals is a major oversight. Most market participants focus on headlines, earnings, or inflation prints. Very few monitor funding conditions in real time, but these subtle signals are often the first to indicate rising stress. Elevated repo rates signal a potential reduction in market resilience and a higher probability of abrupt price moves. This matters for traders executing short-term strategies and for longer-term investors allocating capital across duration, credit, and equity exposure. Quick check. Does this concern you? Type yes or no. Finally, what should traders and investors do? Awareness is the first step. Understand that elevated repo rates imply higher leverage costs, reduced liquidity, and increased market fragility. Short-term traders should adjust risk parameters, monitor funding costs, and observe spreads carefully. Long-term investors should reassess portfolio resilience and be prepared for thinner liquidity conditions than normal. This is not about panic. It's about preparation and informed positioning. The key part is to respect the warning signals while maintaining discipline. Markets rarely break when everyone is watching. They break when stress is ignored. I track market stress signals like this regularly. Subscribe if you want early warnings before volatility. The most important signals in the market are often quiet. Funding markets do not care about headlines. They care about cash, collateral, and confidence. Right now, confidence in smooth funding is being tested. Markets may appear calm on the surface, but stress is building beneath. Do you think this situation improves or gets worse? Comment improves or worse. Understanding these signals is critical for navigating U.S. markets effectively. Liquidity, leverage, and funding costs are the silent drivers of market behavior. Ignoring them risks being caught on the wrong side when stress finally materializes. Stay aware, disciplined, and pay attention to repo spreads. They are currently the clearest warning signal in the market.